Hello, everybody. Welcome to the pre-watch video on dividend decision. Well, by now in corporate finance, you have already dealt with two important fundamental decisions. The first one being where will the money come from? The funding decision, also formally called as the financing decision. And the second one is that once there is money on the table, how would you spend it? That's where you spoke about things like capital budgeting and working capital management, depending on whether you wanted to look at the long-term decision or the short-term decision. In this video, we are going to talk about the third decision for any finance manager, because in case your other two decisions of raising money and putting it have been successful, then there will be some surplus that the business is going to generate. The questions that will arise now is what to do with that surplus. There are multiple opportunities to which you can apply it. Two very broad options are: the first one is to allow that surplus to remain in the business, in which case the size of the firm grows and the firm is much more capable for the next year and the future years to come. The other alternative of using that surplus is to gratify the shareholders by giving them a portion of that or the complete amount as a rent on capital, as a gratification for the trust that they have reposed in the company and the management, and of course the capital that they have contributed. So these are the two broad options that we have, and then there are other decisions as well that will form part of this whole thing. So I'm going to share my screen and we will begin the discussion of this wonderful dividend decision. So like I said, we are at the third pillar where we got to talk about how does the firm want to share the profits with its shareholders. Okay. Now, kind of also set the context through a different lens. Many times we have used this particular slide in order to give you a broader framework as to how we do business. Okay. So in step A, the firm was raising money from capital markets to different sources like equity or debt. In step B, the firm was spending that kind of money into either the long-term assets or the short-term assets. That's where your capital budgeting and working capital management came into picture. Step C is where the customer will come in and generate a lot of cash, hopefully, for the firm, using which the firm is going to repay for all the expenses, such as an employee, a landlord, government for the taxes, and a lot of other associates, generating some surplus, hopefully. So basically, the surplus that we are talking about is the inputs coming from step C subtracted by the outputs going in step D. So C minus D is going to be the net surplus that needs to be debated on. As per the framework also, there are two choices. Choice number one, to reinvest the cash flow and make the company bigger. And the other one is to, this is the other one, is to give that amount back to the dividend. So connecting, the dividend decision with our 6-step framework is where it's either going to be E or it's going to be an F. Now, before we come on to some of the decision points, it's important to explain a very, very important term called as dividend here. Very simple layperson's understanding of dividend is any return that comes out of any investment. So sometimes we even use in general parlance that accumulating knowledge gives you a lot of dividend in your career later on. So dividend has been used in general to signify the word return. In context of corporate finance, dividend is put as return to the shareholders. Now, you're well aware that there are two types of shareholders that a firm may borrow from. The first one is the preference shares, and the other ones are the equity or common equity. the real owners. They have the voting rights. And the preferred shareholders, the preferred equity, one of the preference that they have is that they will be paid the return, the periodic return, the annual return before it is being paid to the equity. So the periodic return that we just kind of referred to is the dividend that we are looking at here. So what I present to you on the slide is the second half of the income statement, also called as profit and loss account, that you have done in the financial accounting course, where it would have started from sales and would have subtracted COGS and other operating expenses such as depreciation to come at something called as your operating profit. That's what is the starting point here, because EBIT divides the whole income statement into two halves, the operating half and the non-operating half. So this debate, the dividend decision debate, as you can very well see, is not the operational debate. Where will the operational money going to come from? This debate of dividend is the below the half of the income statement, where any dollar, and I'm just taking some random numbers, let's say $1,000 of operating profit is being generated, out of which the interest needs to be paid to the debt, let us say $100. This is no more a matter of choice. You're aware that debt, the interest is a compulsory payment. It's an obligation on the head of the borrower, the company. It's a promise to repay, and that's where is I will get a $900 of profit. Let's say 40% rate of tax. 360 is what the company is going to pay, keeping 540 as the surplus. Now, this is that frameworks, 6-step frameworks, C minus D. This is the 540 surplus that the firm is able to generate, which needs to be debated on as to what do I do with it. Option number one, do I retain it in the business and make it grow, make the firm grow? Or option number two, I distribute that. So this 540 is also called as earnings. So what I'm saying is that this 540 have two choices. Number one, it can be retained, therefore it becomes retained earnings, or it can also be called as distributed earning, which can be distributed in or distributed to two different stakeholders, the preferred and equity. So just continuing the examples with some random numbers. Let's say preferred dividend, anyway, you are aware that the rate of preference dividend is fixed. So therefore, we have a face value, let's say 1,000 at the rate of 14%. So 140 is the dividend that will be paid. 400 is going to be the earning attributable to the common equity. And you have this 400 being debated, voted upon by the equity shareholders as to how much of that would they want as liquid earnings in the current year, the dividends, and how much of that they would want to retain in the business. So for example, this is a growing firm, and the common shareholder would have voted that out of that, majority of the portion should be retained. So perhaps a very small quantum will be paid as distributed earning, as dividend, and 350 is going to be retained. So if we go back to our number of 540, out of this 540, the firm has been able to distribute 140 plus 50, which means a 190, and has been able to retain 350. Now, this 350 is what you sometimes also use as reserves and surplus. This is that profit that the firm has earned in the current year, and in addition to that, has not given it out. So this is the quantum. 350 is the quantum with which the size of the firm has grown. This is what is the reinvested earnings. And in different contexts, we have been referring to this 350 using different syntax. Another dimension of this 350 I would want to explore, and I want you to wear your thinking hats right now. Who do you think this 350 belong to? Now, there are multiple claimants for it: equity shareholders, preferred equity, or debt. Who do you think in the next year? Let's assume in the first year, the firm has generated this retained earning of 350 and it is flowed back into the business. Next year, there will be some claimant that might come up, which is year two, and there may be a debate as to who this 350 belong to. What do you think? who has the right on this 350? Does a debt or a preferred have a right on this 350? The answer is no. You know why? Because while the earnings were being distributed, and I'm now referring to this 1000, whatever was due annually to debt, this $100, they did not let go of that, any portion of that. They took the entire 100. Whatever was due to preferred equity, I'm referring to this 140, they did not let go of that and had withdrawn it in the first year itself, which means this 350 actually came out of the portion that belongs only to the common stockholders, which means 400 is that portion of profit which is attributable only to one stakeholder. Anything which is a remainder out of that 400, which is 350 in this case, also belongs therefore only to that stakeholder called as equity. So therefore, while we were doing in accounting, sometimes, we had a balance sheet typically, and we used to ask that reserves and surplus belongs to whom. And, at that point in time, perhaps because the understanding of corporate finance was not given to the student, sometimes, we would bottle it down the throat, as a rule, as a formula, saying that the total worth of the equity shareholder in the business is the capital that they contribute plus the reserves and surplus, meaning thereby that the reserves and surplus is also the quantum owned by the equity. Here is the reason: 400 could have been withdrawn by them, but they did not. They let go of that and continued 350 to stay in the business, and therefore 350, the retained earnings, belong only and only to equity. So I hope that this 190 is the dividend that we are referring to and we are going to debate. The question, and that's going to be the last slide for the video, is what you see on the slide. There are multiple confusion points here, and you have to visualize a situation where there are a lot of shareholders, let's say equity shareholders, who have hired a CEO to run the firm on their behalf. Now, in that context, there are a lot of things that have to be done right in order for the surplus to be generated. People don't think that any company and every company can generate profits, because for profits to be generated, your incomes have to be more than the expense. Your cash collections, in the finance terms, you must receive a lot of cash compared to the cash that you're paying. This is the step C minus D. So it's a hell of a job. In case you're lucky and you have that profit, that's when these questions are going to arise. So before even I look at those questions, let me also tell you the kind of companies who do not have to worry about the dividend decision. The firms which by design are not intending to make money. So those are the firms such as a startup firm, which is pretty young, let's say less than 5 years, whose main objective is to acquire customers and market share, and therefore they are only focusing on the top line, not on the bottom line. Okay. And we are right now in this video not discussing how right that thought process is. Okay. But nonetheless, be that as it may, let that thought process be where it is. And so we are not expecting a startup firm which is like less than 5 years to be even thinking about paying out dividends. The second category of firms who don't have to worry about this decision, and therefore the 5-6 questions that are going to come up, are the firms which by design are supposed to generate profit, but because of some flaw in their doing business, they are unable to generate the surplus, such as sick companies, such as companies whose business model have failed, and so on and so forth. So even those firms which are like pretty old, and by that I mean, let's say, crossing 10 years or more, they are generating losses for some reason or the other, and therefore those companies also don't have to worry about what to do with the dividend, because there is no profit to be distributed. So going back to my the questions that you have. So first question, like we have discussed, should the company pay dividend to the shareholders or not? People, because in finance, and I'm sure like in life, everything has an opportunity cost. So the question is, in case the dividend needs to be paid, the kitty of the company, the value that is there in the company is going to reduce, and the size of the firm is going to become smaller. And that's where sometimes the CEO and the management present it in a manner uh, that dividend actually has a possibility of reducing the speed of growth for tomorrow. So progressive shareholders, shareholders who are not dependent on company for liquidity, may allow company not to pay them dividends, and that's perhaps one of the reasons why private companies generally do not pay dividends. You have a lot of examples. In spite of earning a lot of profit, they tend to not pay dividend because they want to grow very fast. So that's where the why of that decision comes into the picture. Of course, we will in our live classes discuss this why with a lot of examples, and we will draw a lot of contours with Indian and global businesses. But I'm going to leave that discussion right now till this point. Coming to the second and a very important question. Let's assume for a second that the company has decided to pay some dividend. The question is, how should I fix that amount? There are multiple ways in which you can fix that amount. First, of course, is should I pay a fixed rupee per share kind of amount? For example, 100 rupees per share, doesn't matter how much is the profit. Or should I fix a percentage of the profit? Let's say if the profits are X rupees, I will pay 30% of that, whatever that X be. So you can imagine that during good times, since the value of the profits will be higher, the amount paid as dividend will also be higher. So this percentage is called as dividend payout ratio. Okay, and don't worry about the formulas. We're going to talk about all of them in the class. So there are two broad ways in which you can calculate. Of course, there is a third way where the company says that I'm not going to focus on amount that I want to pay. I'm going to focus on the amount that I want to keep for future to reinvest. Whatever be the remainder, I'm going to pay everything out. There is a risk that nothing remains after subtracting the amount for capital expansion next year. So the residual dividend policy, as it is called as, is also very interesting to look at, where you're keeping the amount of dividend as the second order decision. The priority is being given to the investments that you have to make. The third decision that you got to take now is, even suppose that you have decided that I got to pay 75 rupees a share. This is just the decision of how much. You have still not decided in what form do I pay. So it's like saying that you got to give a gift to your friend on his or her birthday, and you've decided that okay, fine, 2,000 rupees is a good budget. So far you've just decided how much should the gift be for. You haven't decided what exactly you would want to buy out of that 2,000. So that's the question. What exactly do the company want to pay out? Obviously, a layperson understands that there is only one choice, which is cash. But in the class, we're going to talk about that there are some non-cash alternatives also. Sometimes a company would want to give the free shares. When would a company want to choose to give free shares versus the cash dividend? And all of that, this is called as stock dividend which is paid in form of stocks. Stock is not the inventory, the finished goods stock. You're aware that India has bought a lot of finance terms as is from the US, and that's where the equity is referred to, the share is referred to as stock. Okay, so that's the non-cash. And sometimes the company might give out some very radically disruptive forms such as inventory. So you can imagine a textile firm who is producing some suitings might want to give out the suitings, the inventory, in form of dividends to them. So what happens on the balance sheet, all of that we are going to discuss, in case of the cash dividend, in case of stock dividend, and in case of inventory dividend. And you got to be very, very diligent out here to draw out the similarity in all of these and the differences in all of these. Let me give you a very, very small hint. Since you're distributing the profit, the impact on profit in all the three is going to be exactly same. What will be the difference is the other aspect, be it the cash, be it the share capital, or be it the inventory. And you don't worry about all of that. We're going to talk about it in the live classes. Okay. Now we're going to talk about the fourth aspect. How frequently should you pay the dividend? There are different ways. Internationally, it is paid 4 times a year. That's called as interim dividend. Interim dividend is, the word interim typically means by the time the thing completes, whatever is what you're doing. So you got to pay dividend after quarter 1, quarter 2, quarter 3, and finally the final dividend. This is what is called as once the annual profits are tabulated. The idea is that the shareholders would need to settle their grocery bills every month. So it's not fair for the company to take their capital and gratify them only once a year. So imagine Jan to December, the shareholder gives you the money in January, you are going to otherwise pay him the dividend in after the December month closes. So almost after 12 months. So if he or she has to buy some grocery, pay rent in the month of February, March, April, how would he or she going to do that? So that it's internationally good practice. And the volatility in business is also much lesser out there. So they can afford therefore to pay some amount with some forecast in mind. Typically emerging markets such as India and other countries where the volatility is very high, which means Q4 has the chances of reversing all the profits of the 3 quarters, meaning the average might become an zero profit, zero loss year. Therefore, the companies, since they cannot take the dividend back, the best way is not to give it interimly. So that's been the psyche of Indian firms, that tomorrow anything can happen. And what if in Q4 there is a big loss? So let me not give it in Q1, Q2, Q3. Let the full year's profit get tabulated. So that's where the debate on frequency is going to come up. And we're going to talk more about that in the class. And then point number 5 is again going to be very, very interesting. Make sure in the class you, have the stamina to understand till here. You know something called as a buyback. And in the class, we're going to draw a wonderful comparison, and we're going to introduce Modigliani and Miller's perspective as to where they said that dividend is actually not a decision. Why are we debating and fretting over it? The shareholders can make the dividend pretty much like Maggie. It's a homemade philosophy. And we're going to talk about a very nice comparison as to a company which has the surplus versus a company which decides to give it in form of cash dividend versus a company, the third option, who decides to give the same money in form of the buyback of shares. How does that pan out? And you're going to figure out that the wealth of the shareholder in all the 3 cases remains exactly same, which brings us to the question that if the wealth of the shareholder is not changing at all, what's the point of discussing all of that? So that's where the 5th point is going to come out. So I hope that it has been a pretty good introduction to what is going to come up in the live class. I look forward to meet you with all the excitement, a lot of numericals, a lot of practice questions. Make sure that you're clear on what income statement and balance sheets are, some of the basics that have to be there with you all the time. And I can't wait to meet you. Thank you very much for viewing this.